In this session, we continue with our discussion on IAS 1, Presentation of Financial Statements. The next feature we're going to deal with is offsetting. What does offsetting mean? It means subtracting an expense from an income or subtracting a liability from an asset and just presenting the net amount. So a debit balance offsets a credit balance. This can either be income against expenses or assets against liabilities. But this is only allowed if, firstly, it reflects the substance of the transaction. So what is really going on? That would be your substance of the transaction. And it's also allowed if it is allowed or required by a standard or an interpretation. So let us look at some examples that deal with offsetting. In example A, we've got a set-off of income and expenses that is allowed. So if we sell a non-current asset, the sale would not be part of the entity's ordinary activities. So the income would not be reflected as revenue. The sales proceeds may be set off against a related expense. What would this expense be? This would be the carrying amount of the asset that we now expense. So if we take the sales proceeds and we subtract the carrying amount of our asset, this would give us our profit or loss on the sale of this asset, and that would reflect the substance of the transaction. So here we would be allowed to set off our income, our sales proceeds on the sale of the asset against the expense. What expense do we have? This is the asset which we are now disposing of, and we are now expensing the asset because we are getting rid of the asset. So our sales proceeds less our carrying amount will give us either a profit or loss on the sale of the asset. Our next example, example B, deals with where the set-off of income and expenses is not allowed. So here we have the earning of revenue from the sale of inventory. So that's our income. And the related cost of sale expense. Are we allowed to offset our cost of sales against our income? No. This may not be offset, since in terms of IAS 1, our first standard that deals with the presentation of our financial statements, revenue must be presented separately. So we must separate our income from our cost of sales. Both of those are separately disclosable on our statement of comprehensive income. Okay, let's look at an example that deals now with the set-off of assets and liabilities that is allowed. So here we have a person who buys from us on credit. So we refer to that person as a debtor or a trade receivable. And they also sell to us on credit. So therefore, they are also a creditor or a trade payable. So we could offset the receivables, our debtor, against our payable, our creditor, if by offsetting both the balances, we were showing the substance of the transaction. Offsetting of these balances would reflect the substance if, for example, we had an agreement in place giving us the legal right to set off, so where we could just pay the net balance over to that debtor or creditor, okay, depending on whether he's a net debtor or a net creditor. So here we've got a set-off of assets and liabilities that would be allowed if we have this agreement in place giving us the legal right to set off. Okay, the next example deals with a set-off of assets and liabilities that is not allowed. So here we have, we owe the tax authorities an amount of VAT, so i.e. VAT payable, a liability, but the tax authorities owe us a refund of income tax. So we've got an income tax receivable. So for VAT purposes, we have a payable, but for income tax purposes, we have a receivable. So are we allowed to offset that payable against the receivable? We would only be allowed to offset the payable against the receivable if South African legislation, being our Tax Act, allows us to do that. But as it stands, our South African legislation does not allow us to do that. We are not allowed to offset our VAT payables against our income tax receivable. Therefore, we would not be reflecting the substance of transaction if we were offsetting our assets and liabilities. So this is simply not allowed. How often should we report? Frequency of reporting. In terms of IAS 1, we should be reporting at least annually. So we need to report on our 52-week period, and if we have a change in our year end, then we need to disclose the following. What was the reason for the shorter or longer period? A reason for a shorter period could be that you only started your business halfway through the year. A reason for a shorter period would be if you decided to change your year end and you wanted to extend your year end, then you would have a longer period. But if you do have a change in year end, you need to give the reason as to why you've got a change in your year end and the fact that your current year figures are not entirely comparable to prior periods. Why is that? If your reporting period is longer or shorter than a year, the amounts in your current year's statement of financial position would still be entirely comparable with the prior years. That is because you are still comparing your assets, liabilities, and equity at a point in time to another period of time. However, if we look at our statement of comprehensive income, it would not be comparable if there was a change in year end, because your statement of comprehensive income is prepared for the period. So if your period is longer or shorter than the prior year, then your statement of comprehensive income would not be comparable. So therefore, just bear in mind your statement of financial position may be comparable because it's comparing figures at a point in time, as opposed to your statement of comprehensive income would not be comparable, as your statement of comprehensive income is a statement that reflects amounts accumulated over a period of time. So if it's prepared for different lengths of time, they would not be comparable. Comparative information. The minimum comparatives we need to include is numerical information and narrative information. Very important is that we need to have a minimum of 1 year of comparative information. So one for the current year and then one for the prior year. So 2 columns, one for the current year, one for the prior year. Voluntary comparatives, we can provide an extra comparative year, meaning 3 columns. You would have your current year, your prior year, and then your year previous to that prior year. And you can give extra comparatives only for one statement if we wish and not for another. But we must remember that our notes must support the statement if we are including these extra prior years on the face of the statement. We must provide notes as well. All our prior year information must comply with IFRS as well as our current year. Compulsory comparatives. An extra comparative year must be given if there has been a retrospective adjustment in terms of IAS 8. So IAS 8 is a statement that you are going to cover later on, and I would like you to revisit the slide when we cover that particular topic. For the purposes of Accounting 211, you do not need to study IAS 8. So what the slide is telling us is wherever we have a change in our accounting policy or we have a correction of error, we need to provide an extra comparative year that refers to our opening balances of our prior year. Okay? This only applies to our statement of financial position, and you must revisit the slide when we cover IAS 8 later on. Consistency. Our presentation and classification should be the same from one period to the next unless there's been a significant change in our operations or our current financial statement presentation is not appropriate and we want to improve, or there's a change in presentation that is required by a standard or interpretation. So your standards themselves may change and therefore you may need to have a change in your presentation. And the revised presentation and classification must be likely to continue and is reliable and more relevant to users. So your presentation should be the same unless there's been a change in your operations or your current financial presentation is not appropriate and you want to improve, or there's been a change in your standards themselves and you need to revise your presentation in order to comply with those standards. Our financial report is the report that includes all our financial statements and a variety of other statements and reports. These other reports would include things such as your director's report, your auditor's report, your environmental report, your value-added report. So IAS 1 gives you the structure and content for all your financial statements except for your statement of cash flows. Your statement of cash flow presentation guidelines will be provided in a statement called IAS 7, which we will be covering later on. So IFRS applies to the financial statements only. It doesn't apply to the entire financial report. So IFRS applies to the financial statements only, and these are clearly identified in the audit report. So for your financial statements, you need to have a full registered name of the entity, the full title of the report with the correct heading, the reporting period and the date, the currency and denomination that we are dealing with, whether this is for an individual company or for a group of companies, and then the level of rounding. Please take note of this slide. It is very important when preparing your financial statements in your tutorials and for your tests and assignment that you need to have all of these details whenever you are preparing a set of financial statements. You will be awarded marks for these items. There will be disclosure marks. And if you do not provide this information, you will lose out on those very easy disclosure marks. So please take note of this. The contents of your financial statement, so IAS 1 applies to these financial statements except for your statement of cash flows. So the statement of financial position at the end of the period used to be referred to as the balance sheet. It's now called a statement of financial position. Statement of comprehensive income or statement of profit and loss and other comprehensive income that used to be called an income statement, we now refer to it as the statement of comprehensive income. The statement of changes in equity for a period. The statement of cash flows for a period, not covered by IAS 1. Notes to the financial statements, the statement of financial position as at the beginning of the earliest comparative period, and then any supplementary reports. So let's deal with the first statement, your statement of financial position. Okay? Your statement of financial position gives you details of what are the economic resources that the entity owns, what is its financial structure, how is it financed? Is it financed via equity or is it financed via debt? How heavily geared is the entity? It also gives us information that allows us to calculate or assess the liquidity of the entity and the solvency of the entity. So your trial balance is split into assets, liabilities, and your owner's equity. So your statement of financial position will have the same classifications. It'll start off with your total assets as your first section, and then you will have a bottom section that will comprise of your owner's equity and liabilities. All your assets and liabilities will be split up into current and non-current portions. So what is current and non-current? How do we determine what is current and non-current? Current assets are those that we expect to realize within 1 year of the year end. So meaning that we are expected to sell that asset or use that asset or realize that asset within 1 year. We hold it mainly to trade, and they are cash or cash equivalents. So we usually list our current and non-current assets in an order of liquidity. So if an item has a current and non-current portion, we must disclose those portions either on the face of the statement of financial position or on the notes to the financial statements. If you have a monetary asset or liability, we need to disclose the maturity date of that monetary asset or liability. So an example of a monetary asset would be something like a fixed deposit that you have in the bank and that will mature after a certain period of time. A monetary liability would be a lease liability that would also mature after a certain period of time. So what I've got on my slide is the definition of monetary and non-monetary. This doesn't appear in your chapter, so this is for your information. Monetary means an amount that can be settled in or converted into monetary terms in a very short time frame, converted into a fixed or determinable amount of currency. So examples of monetary would be cash, bank deposits, or accounts receivable. Non-monetary, these are assets in which the right to receive a fixed or determinable amount of currency is absent. So examples of non-monetary assets would be property, plant, and equipment, patents, goodwill, and copyrights. Your current liability definition would be the opposite of your current asset definition. Instead of being realized, current liabilities would be settled within 12 months after reporting period. They are settled within the normal operating cycle, and they are held mainly for trading purposes. The entity does not have an unconditional right to delay the settlement beyond 12 months after the reporting period. So that's how you know what a current liability would be. Okay? We are allowed to refinance our liability. So a lot of companies would have done this during our lockdown that we experienced last year. A lot of companies experienced difficulties, and as a result, they wanted to postpone their payments for their loans or liabilities. So when we postpone the due date of our repayment, we are in effect refinancing our liabilities. So when a non-current liability falls due for repayment within a 12-month period, we usually classify those liabilities as current. But if it's possible to refinance the liability beyond 12 months after the reporting period, then the liability can still remain as non-current. So there are two instances when a liability can remain as non-current. Firstly, if we take out a new agreement to refinance that liability, then that agreement must be signed before reporting date. So that is if we have a new agreement. If there's an existing agreement in place which has an option to refinance, where we can delay that payment at least 12 months after the reporting period, it must be at the discretion of the entity, and the entity must have an intention to refinance. So we will look at examples of refinancing our liabilities in a later session. Breach of covenants. Covenants means a promise made by a borrower to a lender included in a loan agreement. So if it's broken, a lender may demand payment or part or all of the loan. If your covenant is breached, the portion must be current unless the lender agrees prior to the end of the reporting period to grant a period of grace. A period of grace would be a period in which we do not need to pay an installment. So your period of grace must be for more than 12 months after the reporting period, and your lender may not demand payment during the grace period. Okay? If you sign this after the reporting period but before the issue of financial statements, the liability will be classified as current, but information must be disclosed in the notes to these financial statements. Statement of financial position. There's a list of line items as per IAS 1 that must always appear on the face of your statement of financial position. Extra disclosure on the statement of financial position will occur based on judgment, which is needed to decide if further line items or headings or totals are needed. You can only have these if it is relevant to the user's understanding, and in the case of asset and liability items, you must consider assets, the liquidity, the nature and the function of these assets, and for liabilities, the amount, timing, and nature. So if we have a look at our textbook, we are given a sample or a skeleton of our statement of financial position. So if we have a look at the skeleton, what I want to draw your attention to first of all is your heading. You've got your entity name, you've got statement of financial position, and very important are these two words, as at. Okay, that's the only statement that has these words as at, because it's at a point in time, and then you've got the full date. There's no abbreviations on the face of our financial statements. So in your tests and assignments and your tutorials, you must ensure that you have a full date and there's no abbreviations. Okay, then we have our two sections. The top section is assets and the bottom section is equity and liabilities. This is further broken down. Your assets section is broken down between non-current assets and then current assets, and they are listed in the order of liquidity. Your bottom section is then split into your equity portion, and this is called issued share capital and reserves. Okay, so this amount would be the amount we'd expect to see as the total on our statement of changes in equity. It should be the exact same amount on our statement of financial position. So in your tests and assignments, you usually get a disclosure mark for ensuring that this amount ties in then to the balance on your statement of changes in equity. Your liabilities are split between non-current and current liabilities. Okay, if we look at the columns that we've been provided in the skeleton, we've got the current year and we've got the prior year. We've also been told the currency, is it in rands? What currency are we dealing with? We are also given the rounding, it's been rounded off to thousands, and then we've got all the relevant subtotals for each section of the statement of financial position. So this is a skeleton I would like you to use when preparing your tutorials and practicing your statement of financial position type questions. The statement of comprehensive income has two parts. The first part is known as your profit or loss section, and the second part is your other comprehensive income section. So you are given a table in your textbook that lists the components of other comprehensive income, what is relevant to accounting 2, IAS 16 PPE, and IAS 38 intangible assets, any changes in your revaluation surplus, and then IFRS 9 financial instruments, gains or losses on your financial asset measured at fair value through OCI. So those line items you will revisit when we cover those particular standards this semester. Please revisit the slide. You need to know which items need to be disclosed as other comprehensive income on your statement of comprehensive income. So there are two formats that we can use, a single statement format or a two-statement approach. Okay, so let's have a look at what they would look like. In your single statement approach, once again, I draw your attention to the entity name, the heading, and then your full date. And I want you to take note, this is for the year ended, so it's for a period of time. Income items less expense items, that gives us our profit or loss for the period. So this is the first section of our statement of comprehensive income. The second section is our other comprehensive income section. So these are the line items that we have to include in our OCI, and that will give us our total comprehensive income. So this is a single statement approach that we can use. The two-statement approach has two separate statements. The first statement has a statement of profit and loss only. The second statement is a statement of comprehensive income. Okay, so in a test or an exam, you would need to opt for whether you want to use a single statement approach or a two-statement approach. If I were a student, I would always use a single statement approach, because as you can see, we have one entity name, one heading, one year end, as opposed to having to repeat that in a test or an assignment. So we'd be saving time by using a single statement approach. So let us look at the two-statement approach. The first statement deals with profit and loss, so it only has income and expense items. The second statement starts where the first statement ends. So in our first statement, we ended with profit or loss for the period. We carry forward these numbers to the top of the second section of our second statement, I beg your pardon, for your statement of comprehensive income. So we start off with profit or loss for the period. We give details of our OCI items, and then we'd have our total comprehensive income for the period. Disclosure of your statement of comprehensive income, we'd have to split our headings between what will be classified to profit and loss and what will not be classified to profit and loss for other comprehensive income. And for the presentation of our expenses, we can either use a function or a nature method. So if a question is silent on which method to use, you need to use the one most appropriate for the information that has been presented. So the function method would mean that you would have to classify your expenses as your income and expenses as sales, distribution, admin, or other. And if you're using the nature method, you would simply then list your income and expense items dependent on the nature of that income and expense. Your notes will provide more details of expenses so that the user can predict future cash flows. So let us look at a sample of our statement of comprehensive income. The first one that we're going to look at is one that deals with expenses analyzed by nature. So you can see we have revenue, other income, and then we simply list all the different types of expenses that we have. So this is the nature method, and let us look at how different the function method is. So when we are looking at the function method, the headings, everything is the same. Here we have revenue, so that would be our sales. Cost of sales would be part of sales. And then we have distribution, admin, and other. So as opposed to our nature method, when we could actually see what the expenses were, we could see there were raw materials and consumables, employee benefit costs, and depreciation. Under the function method, you can see these have been classified into different functions of the business: sales, distribution, admin, and other. So you will have examples of these in your tutorials for you to practice, and the classifications of sales, admin, distribution, and other will always be given to you in a question. You will not need to make that classification yourself. You will always be told what is considered to be sales, admin, distribution, and other. Reclassification adjustments. This is when we have a gain or loss that was recognized as other comprehensive income, and we now want to classify that as a gain or loss in the profit and loss section. So a reclassification adjustment refers to a journal that reverses an item out of OCI and puts it into profit and loss. So reclassifications can never occur with revaluation surpluses or defined benefit plans. So you ignore that for accounting 2 purposes. The reclassification adjustment must be presented together with the related component of OCI in the period that the income and expense is reclassified from OCI to profit and loss, and may be presented either on the face of the statement of comprehensive income or the notes to that statement of comprehensive income. Any changes to profit or loss not presented in the current year. So if we have a change in accounting estimate, then we will make a prospective change to our profit or loss. All of these adjustments are made in the current year. So at this point in time, you do not have any examples dealing with this. We will look at this when we study IAS 8 later on this year. The same applies to this slide. If we have a retrospective change, so if we have a change in our accounting policy or if we are correcting an error, then we would change our profit and loss in the current period, and we would need to change our opening balances. So there is disclosure that needs to be provided for each prior period and our opening current period balances. So the adjustments are not shown directly on the face of our statement of comprehensive income, but they are actually shown in our retained earnings opening balance, and these are shown on our statement of changes in equity, not in our statement of comprehensive income. So I do not want you to stress about IAS 8 now. We will cover the standard at a later stage. You must remember to revisit this slide when we start our topic IAS 8. The next statement is our statement of changes in equity. So for each component of equity, we would have a column on our statement of changes in equity, each class of contributed equity, our retained earnings, and our 6 components of other comprehensive income. So you would have a column for each of those. Disclosure in general, for each component of equity, you would have an effect of a change of accounting policy or correction of error, and a reconciliation of your opening to closing balances. You would have your total comprehensive income for the year, and then you would have line items for transactions with the owners, so your shareholders. So you would have contributions with your owners, so if you had issued shares, for example, or distribution with owners. So if you declared a dividend, then those dividend distributions would appear on your statement of changes in equity. Okay. There are 2 formats for your statement of changes in equity. Firstly, if you are showing or preparing a statement of changes in equity for an individual company, there's a format provided to you. Or if you are preparing a statement of changes in equity for a group of companies. So the skeleton that's been provided to us for an individual company would look like this. We would have our entity name, statement of changes in equity, and very important, this is for the year ended, and then we've got our full date. And then you'll see here we've got a column for each type of equity. We've got ordinary capital, retained earnings, other comprehensive income, and then we've got a total column at the end. And then this is our prior period, and then we've got our current period. So we've got our current period, and I beg your pardon, we've got your prior period, and we've got your current period. So the bottom section here is your current period, so the year X2, and here you've got your comparative period, your prior year period on your statement of changes in equity. Your statement of cash flows and the notes to your annual financial statements. Your statement of cash flows you would have covered last year in Accounting 1. Your statement of cash flows gives us information about cash inflows and outflows from operating, investing, and financing activities. So a statement we'll cover later is IAS 7, which covers in detail the presentation of our statement of cash flows. You need to revise your statement of cash flows that you would have studied in Accounting 1, and you would need to know the format of your statement of cash flows. We will not be repeating that now under IAS 1. The notes to your financial statements need to follow a systematic and logical order. You'd start off with your accounting policies, which are significant and relevant, and any judgments that were made by management. And you don't have samples of notes or skeletons of notes in your chapter. So you would need to build up a skeleton of notes for every example that you attempt. So every tutorial that you attempt will give you practice on different types of notes that you have to prepare. So using your solutions, I would like you to build up a set of skeleton of notes for yourself to study from. So for every standard that we study going forward, you must build up a skeleton of notes for yourself that you can use not only in this year, but in your following years of study as well. Okay. That brings us to the end of Chapter 3 that deals with presentation of financial statements.